Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for tuning into Bloomberg Quint and BQ Conversations. My name is Neeraj Shah, and amidst all the conversations that have surrounded the NBFC industry since the IL&FS issue first broke out, very special guest with me to talk about how the last 6 months have been and how the next 6 to 12 to 18 months could be as well. Nirmal Jain of IIFL needs no introduction with us in the studios. Nirmal, so good having you. Thanks for joining in.
Thank you.
Opportune time to have you. There was a report that came in from Care Ratings which suggested that bond issuances stepped up big time in January 2019. Right. A large portion of them would have been done by NBFCs in particular. I'm guessing the response was good. Is it a sign of the industry slowly limping back to normalcy, or is it difficult to say that right now?
So in a way, this is disintermediation, because at the end of the day, people or the investors invest money either in mutual fund or banks. So I say they invest money in bank, a debt mutual fund of a mutual fund scheme, or a bank fixed deposits, and banks in turn lend it to corporates or NBFCs included. And similarly, mutual funds also can lend it to NBFCs. And now there's a scare about NBFCs credit, and primarily after the IL&FS fiasco that happened a few months back. So what that has done is that so in mutual fund, credit funds and liquid funds, what happens? Many corporate treasuries invest. Companies like say Sterlite, Tata, and their finance department might get very hypersensitive. They start asking questions to mutual funds: who are your, who are the companies or who are the entities that you lend to? And many times what happens is one NBFC, and they would try to paint the entire NBFC sector with one brush. And then basically, so mutual funds are scared, or they're very, very hesitant to lend to many NBFCs. And so in a way, this is a good thing that is happening, because this is a disintermediation of sort and a dispersal of risk in a way. Because what happens that many investors can directly invest, they can take a credit call. So bond issuances, they started few years back. Again, somehow, those they did not carry it through properly, or that trend did not become, sort of an established practice. So it's coming back. But it's a long way to go, because in India, bond markets still are in very, very nascent stage. So if you compare India with any other large market, then the corporate bond market is very, very small. So whatever issuances you have seen in January is just the tip of the iceberg. If the government regulators support it properly, then this can really become a good source of, in a way, this is a win-win, because investors are investing directly. So to that extent, your cost of intermediation also goes away for the entities that are borrowing. And longer term, it also basically makes sure that the risk is not concentrated but dispersed.
Okay. No, but okay. The larger point of me asking this question was that in the immediate aftermath of what happened in IL&FS, almost every NBFC, and rightly so, was sulking about the liquidity availability. Commercial paper rollovers might happen, might not happen. There's a lot of question marks out there. NBFCs, in their own words, said that we are holding cash right now because we don't know when the next demand will come in. The ability for NBFCs to raise money in the month of January, you yourself raised some money as well through issue of NCDs. Is this a sign that there is acceptance of the NBFC paper?
Very interestingly, IL&FS, although technically maybe could be an NBFC, but was really more like an infrastructure company and not a proper NBFC the way the other NBFCs are. So no NBFC has defaulted in the last 4-5 months, despite media headlines every week, covering stories, telling, the social media abuzz with all kind of rumors. And even the NBFCs, one or two NBFCs that have been under attack, from media or from the rumor mill, have honored all their commitments. So this goes to the credit of regulators also, because they created a robust framework after 1998 disaster that had happened when many NBFCs went bust together. But after that, I think so. In a way, this is a proof that the regulatory framework is working, and the risk dispersal also, or the risk mitigation also is working. So even if you look at IL&FS, there is no large bank or lender that has a large exposure. So, there are exposures, but they are all distributed and fragmented, or they are not really concentrated. And that is how, see, in any system, out of 100 entities, 1 or 2 entities can always go bust. You can't have you can't have any economy or any financial system where you say everybody, there'll be no insolvency at all, or there'll be no, everybody will be above will be foolproof in terms of investment.
But the insolvency or a default of sorts from systemically important organizations like NBFC would have far more repercussions.
No doubt about it.
And part two of this also would be that while I take on board the point that regulations have probably helped, the easing of the regulations helped tide over the crisis.
No, I'm saying a different thing. I'm saying that the regulatory framework has been robust enough to make sure that no NBFC defaults, one.
Yes.
And two, the liquidity tightening. So many times it may not be a solvency issue, but a liquidity issue.
Sure.
There also regulators and banks have stepped in at right time to make sure that liquidity is not tightened because of fear factor. That even though it's like a heart attack in a healthy body, but that should not happen.
But don't you agree, Nirmal, that the fear factor was alive and kicking, and rightly so? I mean, yes, we've gone over the crisis as things stand right now, but it could have worsened if some steps were not taken in time, some choking up was not done, because let's face it, companies themselves said that this is a black swan event.
So yes and no, because you can never have an alternate history. If we had done this, whatever happened, we would never know that.
True.
But to my mind, in India, the media and social media, basically they exaggerate the fear, and something which was a small issue looks like a big issue.
You're calling IL&FS a small issue?
Of course, it's a small issue from the economy's point of view.
Okay.
Because see, IL&FS is not that the entire, say, whatever the 1 lakh crore, whatever has gone, is lost or is a scam or a fraud. So it is a situation where your total assets may not meet total liabilities, and all the lenders may have to take some haircut. Okay.
Okay.
Now that situation basically is bound to happen in a large economy like India. So IL&FS is neither the first nor the last. But it got exaggerated so that the entire NBFC sector started feeling choked in terms of liquidity, in terms of the rumors and everything. Sometimes what happens that panic, if taken beyond a point, can actually cause a real problem also.
Sure.
We are talking about NBFC sector, and many NBFCs have met the call on them, which have been very large part of their borrowing, right? Even the State Bank of India, 10% of deposit holders say have a run on the bank. It's very difficult to meet the obligation.
Okay.
So in financial world, anywhere, any bank or any large institution, if there is if there's a crisis of confidence and there's a run on the bank or any lending institution, it's difficult for anybody to meet that. That is where the regulator and central bank has to step in and make sure that these kind of crises do not blow up into a more serious than that.
So are we behind that now? Is fresh credit getting created, or are NBFCs still have to?
A few more things happened in last few weeks. One was this entire episode of loan against shares. Another one was the judgment on the Jharkhand SPV of IL&FS. So, what happens is that these kind of things can create fresh panic and a different kind of panic. So supposing there's a secured asset in SPV and those cash flows are mortgaged for a particular liability, now I think the judgment of NCLT has questioned that. Now that can cause a fear factor, because then nobody can actually do a secured lending also. Because if the unsecured and secured, by some twist of interpretation, if they come on par or even they come close, then that can be a real serious issue. So that caused a fresh new wave of panic. That what will happen, because the SPV of IL&FS, the cash flows have not gone to the lenders of that SPV, but there might be. So many times what happens that these kind of things, which in democracy and judiciary where they work independently, it can happen, but they are all part of the game. I think they get resolved over a period of time, either by judgment of a higher court or by law or legal amendments. So I don't have a crystal ball to tell you that what will happen next 3 to 6 months.
Of course not.
Right?
But do you think that the worst of the crisis is behind us?
I think the worst of the acid test, the trial by fire is behind us.
Okay.
But there can be a new one. You never know.
Of course.
But for the time being, I think at least for next, one should not panic. I mean, I will not panic and say that everything is. The kind of defaults what we are seeing in India. You take any developed market, any large market. The only difference is the media will not highlight that as if like it's a front page news for every day.
You're attributing this crisis of confidence to media squarely. I take offense to that.
No, see, you are one of the media, and you really can't say that Bloomberg works the way everybody. Not only media. In India, social media is very active.
Okay.
So we are the largest country for WhatsApp. So. Okay, but that's all. I don't take offense to that. I say this is all part of the. You'll get used to it. Yes.
So let's move on then. So let's assume that the process of survival, quote unquote survival, or the asset test is behind us. What happens here on? If no other large incidents happen, what happens to growth? Because the last few years...
That's a very good question.
So last few years, NBFCs took over the space that was vacated or vacant because banks were not willing to do that. There was a belief when IL&FS happened that banks will now come back and there will be some bit of rebalancing. Do you sense that?
See, yeah, that's true. So NBFCs were accounting for almost 33% of incremental credit. And there are some people who feel that now NBFCs credit will go away and PSU banks will start lending and private sector banks will fill the gap. I find it difficult to believe.
Okay.
So NBFCs have slowed down the disbursal in last quarter, and maybe this quarter also will continue. But they are limping back to normalcy. So one is that the demand for credit has not gone down because the economy is doing well, and the demand at the bottom of the at all levels is still there. Now the question is, public sector bank credit also had grown, and even private sector banks also growing. Can they really fill the gap? And will the NBFC's incremental growth be always slower? That's a question that we want to debate. So most of the NBFCs, they fill the gap because they connect the last mile that banks will find it difficult to do it.
Sure.
So now when you're talking about a small loan to a small and medium enterprises who don't have income tax record, they're not filing income tax, and the loan size may be 50,000 rupees, 1 lakh rupees, 2 lakh rupees, right? And then you require your young guys to collect also in time, because collection discipline is also something that you need to maintain. Most of the PSU banks, they are large, and average age of staff there may be 50, 52, 53 kind of a thing. It's really difficult to imagine that they will disburse 2 lakh rupees, 3 lakh rupees loan and do the collection with the efficiency that NBFCs are doing. So the complementary model is that NBFCs do the credit, either in the co-lending model, but they take the responsibility for collection also, and they sell their assets to public sector banks, or they do co-lending in the new guidelines. So I think that is what will work. So in this crisis, what has happened that the two categories of NBFCs are very clearly differentiated. The NBFCs that lend retail, the small ticket lending, and they are actually, so they specialize skill in the niche segment. So in every niche segment, you have to have a credit appraisal as well as collection skills. And then the NBFCs who do large scale wholesale funding. So wholesale funding has been primarily of two types. One is a real estate developer, and the second is loan against shares. So I think wholesale funding NBFCs have seen the increase in cost of funding much more than the retail funding NBFCs. Okay. So the NBFCs that do wholesale funding will have to rely more on bonds and other sources of funding because they really can't securitize their assets and get the money from banks. So, but the cost of funds might be higher, but then they can charge also higher because they basically price that in when they're lending onward to large borrowers.
We saw that in your results maybe this time, but anyways, I will get to that.
Sure. So that is what is actually is happening in the industry because industry is getting bifurcated in a way, and I think that's the way forward.
Okay. So the fear. Okay, there are a couple of things to this. So the takeaway for me from your answer seems to be that the growth rates as well, the breakneck speed at which NBFCs have grown, you believe that there might be a temporary mismatch, but eventually we'll get back there.
Most segments of that will get back to that.
Most segments.
Yes.
Okay. What about the overhangs of a couple of businesses which may hamper this? So loan against shares doesn't necessarily hamper the NBFC as much as it hampers maybe the system and the equity markets per se. But loan against developers and the fragile space that real estate seems to be right now, how big an overhang is that?
So even loan against shares for that matter.
Okay.
There also, I think that when the promoters basically borrow, at least the 20% or whatever minimum holding, the regulations should not allow that to be encumbered. So, supposing if I'm a promoter, then the minimum 10%, 20% or whatever stake, I should basically not be allowed to pledge or create an encumbrance, because I think that kind of regulation will give stability to the promoter lending or a loan against shares market, because if 95, 100% of companies pledge, then it becomes a bit of a chaos on the panic also.
Yes, sentiment is also bad. Yes.
Then you are talking about the developer space, which is fragile. Now so in India, real estate is viewed as if something wrong or a fragile or this thing, which is perception is happening because where we are sitting right now. the 2-kilometer radius from here is the epicenter of all problems, because that's where real estate prices are very high and the end user demand is relatively less and people are scared whether builders will be able to sell. But this is not entire India. If you get out of this and you see the real estate market, say in suburbs of Mumbai, you go to Borivali, Virar, Thane, Kalyan, Panvel, or you go to say Bangalore or Pune, or you go to even cities like say Lucknow or even Jaipur, or I'm talking about
wherever, anything
there's not as much panic, and there the industry works in a different way. There the component of land cost in the total cost is lesser. So basically, you may incur about 2,500 rupees to construct and you may be selling at 5,000 rupees or 4,500 rupees, right? There you'll not see a price fall or a risk of this magnitude. So on one hand, if our government has a motto that you want to have housing for all by 2022 or whatever year you put in place, and they're giving so many incentives for housing and particularly affordable housing, obviously the real estate sector has to exist. Who's going to construct? Okay, and the developers have to be funded, otherwise the whole industry will not take off.
Yeah.
But the industry is getting this fear or a little bit of a, for want of a better word, I can say bad name, because of very large exposure in this market, which is where we are sitting right now.
Yes.
But that is, so we have to, so that's where there's maybe risk. And that is where...
How high is the risk? So everybody knows the risk.
To my mind, again, whatever understanding or knowledge I have, which is not something with that, I think that the risk is not as high as it appears from outside, because in most cases, collateral is there. So most lenders would have done 2 times cover, or at least, So unless, so they may have to take, what will happen is that there may be some haircut or some losses here and there, but it's not a crisis where there is a fraud. It's not a Ponzi scheme. The real estate is real.
Yes.
The prices might correct. When the prices might correct, the builder or the developer may not have any equity left. But in most cases, lender might recover their dues. In some cases, lender may have to take some haircut, but that's part of the game. But it's not a disastrous situation where everything is okay. See, in 2008 in the US, what happened? The mortgage industry throughout US had a almost fall of 40-50% kind of a thing, and the entire industry, so lender after lender, bank after bank, institution after institution basically went bust. I don't foresee that kind of scenario in India. So the scenario here is that many big developers in concentrated region of Bombay, maybe a few cases of Gurgaon you can take, or a Noida you can take, where people might have but maybe 80-90% of problem is in this high price pocket of Mumbai. And there again, as I said, that many builders might lose their equity or significant part of their equity. And the worst case scenario is some lender might have to take some haircut. But
But you don't foresee it so large.
But there's no question. At least I personally don't see any systemic risk in real estate sector also.
By that, you're admitting that in IIFL's books as well, there is no exposure to a particular segment. That there's no exposure to a particular book which could hamper the book in a meaningful way. So
in IIFL, we are very transparent. So if you attend our analyst call, so then in our total book, we give you a complete breakup of that. So in our real estate exposure or developer exposure, about 10% of our total book or AUM. And there also, in last quarter, our gross NPAs had gone up to almost about 9%, because if you are 91 days, then you get classified as per RBI norms currently. And obviously, when the sales are slow because of the fear factor, but as we have said, that in all cases, we have a collateral which is adequate.
Okay.
But we are predominantly a retail company. So if you look at our book, 90% is retail. And incrementally, we want to be almost entirely retail. So what we have done is that in a group, in our wealth, we have a subsidiary company in which we have alternate investment fund. So we are raising fund. And very recently, we had a India Housing Fund, which basically will in turn fund the developers. And we had 6 funds earlier also for real estate. And out of that, 2 we have given complete exit with almost around 17% IRR, which again is unique in the industry. So our track record of funding in real estate and collecting is very good.
Okay.
And going forward, I think that's the model, because what happens if you have 10 or 20 projects, one can get into liquidity or a cash flow problem, but you pull in the risk, and then people can get good return also, and the risk gets diffused.
Okay, so let's talk about the 3 businesses then, and let's start off with wealth, since we were talking about that. In the past, your wealth business has shown very good ability to toggle between equity, structured debt, real estate, so on and so forth. FY19, you have to admit that the agency realizations are showing a sharp drop quarter after quarter. What's happening here, and how much pain, quote unquote pain, do you reckon, or how long can this slightly moribund growth last?
So there are two factors there.
Sure.
One is, of course, the market conditions. Because if the assets move from equity to non-equity, your average fee income might drop a little bit. But more importantly, we are the first wealth management company that way to make a decisive move from transaction or a distribution-oriented model to completely advisory or fee model. I mean, when I say this is our preferred mode, and we are encouraging customers to sign up IIFL1, which is our advisory service. And also, we have made certain changes in the accounting to take these things on accrual basis. So let me explain it to you. How does it work?
Sure.
So we have, say, 1,60,000 crores of assets, and the incremental flow can be 25,000 crores every year. So part of those assets, supposing they are going into a closed-ended or a AIF structure, where if we can get upfront income, and based on India standard, if the upfront income is fully yours with no liability or no recourse, then what happens that upfront income gets recognized in the year of income receipt, right? Obviously, then it becomes lumpy in the year of receipt. But when you make a transition where we say that now we're going to do everything on accrual basis only, then what happens that your income might drop when you do the transition, but over a longer time period, it makes it a very sticky business model. And in IIFL1, what is happening is that supposing we charge you 50 basis point or 60 basis point, but then we don't charge you anything for transaction. And even for these closed-ended products, either from mutual fund or AIF, we give you a separate series where the distribution fee or commission is waived off completely. So what happens from a client's point of view, it becomes very transparent, one. And two, although the fee is coming on an accrual basis, it becomes win-win, because otherwise if I'm taking upfront, I'm taking the discounted value of it. But if I take it over every year, the aggregate may still be more. So I think there's a change in that business model has also resulted in a drop in the reported income. And of course, when the capital markets are little, facing headwinds, you'll see some drop in that income. But that business, the beauty of that business model is whether equity markets are doing well or not, the clients are with us, and we can toggle their, we can shift their allocation from equity to fixed income. But that is what a customer, our investors, our customers expect us to do. That is what our advisory is for.
Sure. Okay. So is business not getting impacted at all, Nirmal? That's my question, right? Because in a high growth business, which has been hit by what the industry called a black swan event, your expenses stay high, but the income lumpiness comes to the fore. Your numbers also show signs of some bit of moderation, right? What happens then? I mean, do you scale down business at the risk of missing out when the cycle turns back to normalcy? What do you do?
Unfortunately, this is a business where you really can't
time it.
Have quarterly numbers bias you from how the business is doing, okay? So as an entrepreneur or as an owner, I look at the flow of assets. I look at assets under management.
Sure.
So if there's a net flow of money, then I'm happy, because then I'm getting new customers and I'm getting new money. Whether I make lesser income on that or more income on that doesn't make any. So suppose this is a private business, okay? I'm not doing it from a quarterly point of view, or you are doing the business. What would you look at? That whether I'm getting more and more money to manage or not. That's the key thing. Whether I'm adding new clients. So from that perspective, we are very happy with the way business is progressing. So there can be cycles when you get a slightly lesser fee and cycles when you get a higher fee. But as long as you are getting new money and new customers, I think business is doing very well.
Okay. Would you believe that the book and the quality of the book from where it is right now to 3 years out will be substantially higher and substantially better, or is it difficult to say?
You are talking about wealth book? Which
the
book?
Overall book. Let's say I'm talking about IIFL as a consolidated. You will have 3 separate entities in due course of time, but let's start off with wealth, let's say.
So when we, so there is one is a loan book or the loan assets that we have on our balance sheet.
Which is, okay, fine.
So that is retail and that is very good, and we maintain the quality of those assets very, very carefully. Then there are customer assets that we advise, and we basically service them. So there's a wealth that is there in customers. So there can be 3 components of that. One is where we have a distribution relationship that, for every transaction we take customers' approval and make investment. Then there is advisory where we advise, but it's a non-discretionary, and then there's a discretionary. So on all these 3 components, I think we are very happy with the way customers' assets are. And of course they can be moved from equity to debt to this thing. But absolutely no problem with the quality, no problem with any where customers have lost money because of some reckless investment. No questions about that. All our customers are happy that way. And what happens that sometimes when you're a market leader, and sometimes you may be subject to a lot of rumors, and sometimes can be frustrated competition or people who are watching, and that the rumor mill can go anywhere. They can talk about your book or your customers or compliance, regulations, everything. But what I want to assure you and also the viewers is that there's no problem. So I can say that IIFL Wealth is in the pink of health. There's in terms of whether it's quality of assets, quality of books, or strength of our relationship with the customer, or the advisory response, the fiduciary responsibility that we have, which we are delivering to our customers. Everything is in absolutely good shape.
Okay. My final question, Nirmal, would be about whether the business itself will continue to earn the same kind of IRRs, consolidated business, as you've had in the past. Because you yourself, I think, we speaking to Prabodh when you raised this round of money that you did, it was arguably at a much higher rate than what you would have 6 or 9 months ago. Is this the nature? Is this the new normal? And therefore, would margins come off?
So cost of borrowing had gone up in the wake of liquidity crisis.
Had gone up?
Yeah.
Has it come off?
Now it's at least stabilizing and showing signs of coming off, okay? So our weighted average cost of funds, if you see last quarter, had gone up by some 40-50 basis points. The advantage of our business model is, given I'm talking about affordable housing or gold loan or SME loan, which is a small business loan, I can pass on this cost increase very well, very comfortably. The book growth, I think will come back this quarter, next quarter. So I don't see any, at least at this point in time, any significant challenge in maintaining the ROE over medium to long term. And again, one interesting thing, the cost of borrowing that had gone up for us had gone up lesser as compared to the peers. Okay, so on the like-to-like, so if it had gone up, say, 40-50 basis points for me, then my peer who was in a similar boat might have had 70-80 basis point increase. So I am that way quite comfortably placed in terms of how lenders perceive me. And again, as we are seeing the rate cut now, and we are seeing that the inflation is low, next 3 to 5 years, my view is that interest rates in India have to come down significantly. They've been maintained at a high level artificially for too long. Primarily because, and this is last 200 years history if you see, nobody can afford real interest rate of more than 1.5–2%. No businesses, the economy or industry. In India, real interest rate has been high, 4–5% for too long, and that is impacting the growth of the economy and the industry. So it's truth about any market, any economy for last 300 years, okay? So if the inflation remains low, given the crude oil prices, food inflation, then the interest rates have to be brought down. There's no choice. And if the systemic interest rates come down, then they'll come down for us also.
Okay. Well, we wish for all of that and more. Would have loved to talk about the macro developments as well, but afraid we are running out of time. But thank you so much, Nirmal, for joining in today. Really appreciate your time. Viewers, thanks for tuning into this leg of BQ Conversation.
Thank you.